There's not much to smile about. There's only one thing, his retirement account, or his investment account. Last year, it was up 20%. Oh boy, we're about to wipe that out in weeks. And suddenly that one smile point goes away. And there's nothing but darkness. And when you have no hope, no place you can look and smile, that's when emotion comes into play. And fear and volatility and uncertainty. And that will help the monetary metals. And also it will impact the day-to-day life of average American, just like the 2008-9 collapse did, finally late in that bear trend, excuse me. We had in the street type of pain, personal pain, not just stock market. News stories that are, whether they're true or not, there's a bigger picture here, and it's the ongoing monetary decay and a crisis now in fiat currencies and debt of governments that is far bigger than any of who's doing what now and when. Gold was going to go up whether China got it behind it or not. And they're now printing money like crazy to help support their market. By the way, their market is not a bubble. The Shanghai Composite is only double the price it was in 2009. We got the 9-fold and 18-fold. So now they're back to printing money, but to hold their market up, and they will go down economically, I'm sure, if we suffer a global downturn. And our metrics say that the Nikkei and the Sensex have now broken as well. So we've got major countries around the world that have signaled the onset of bear markets, and with that will come economic downturns very rapidly. So everybody's probably going down economically. But the question this time is, we do this over the decades, and it seems like boom, bust. Bigger boom, bigger bust, bigger boom. This time it's going to be, I think, total cleansing, where many institutions, many economic government assumptions, investment assumptions are going asunder, where people will say, geez, it's different this time. I don't just mean how much the stock market drops, but the other realities that will be exposed out there. And a lot of people aren't talking about them. Like right now, even just looking at the market, people are looking primarily, well, what's NVIDIA doing? What's the big seven doing? They need to be looking at the financials, the banks again. And we're looking at them, and we're also watching commercial real estate, not residential home builder stuff, but commercial real estate. Because those arenas look very vulnerable to us to creating a sudden headline type crisis off to the side that nobody's talking about. You know how those can pop up. All of a sudden, it's not a regional bank. It's, oh gosh, one of the biggies. He has a problem or something. Or a major asset management firm is suddenly in deep trouble. Now, another arena that I think is moving with the market, with the NASDAQ 100 in particular, is the Bitcoin situation, the crypto market. We think it's topped. We think it is a major bubble. We think it could break savagely already. If you just look at what's happened, we've gone from 110,000 Bitcoin down to 76,000. Whoa, in a matter of a couple months. That in alone is a collapse. We rebounded up to 90. Right now we're trading about 80,000. I'm arguing you get back down to that low we just made, 76,000 area. Again, they're going to pull the plug. In other words, you're going to see even more serious drop. The problem is that is a heavily retail invested market. It's not an institutional invested so much. Now, there's some institutions that have produced products like ETFs in that arena. So they've got commitment that way. But it's a heavy speculative retail, highly leveraged market. And so that could cause a lot of financial pain, which could, because it's moving in sync. If you'll look at like month to month on Bitcoin and NASDAQ 100, they look like brother or sister. Except recently a far more severe drop in Bitcoin. But that's another factor that's outside the stock market that is now in sync with it. And quite often these things cascade, and it's the thing off to the side that you're not looking at that suddenly smacks you in the head. And you say, oh gosh, I didn't think about that. Expect it. If gold went to 8,000, it's no big deal. Why that number? It's not a projected target or anything of the sort. All I've done is go back to when gold was legalized, 1975. You had a couple of bull markets that were eightfolds. From the mid 1976 low to the 1980 high was $1,003 up to $850. Okay, 3.5 years. Then over a span of a decade, you went from early 2000s up to 2011. It went from $260 to $1,920. Okay, another eightfold move. Now we have fundamental and technical dynamics that are in play that are far bigger than those periods of time. So the excuse that gold had to do that, you got the same excuse now times 10, okay? But if gold barely went to 8,000, that's merely replicating an eightfold move that you had 2 times before in the last 50 years. So if you go to a ratio or a log scale chart of gold monthly, go back 50 years, put it up on your screen, and look at what we're doing now, it looks tepid compared to those bull markets. We went to 8,000, at least you'd say, oh, I'm doing it again. So we throw out the 8,000 number, not as a target, just saying, you know, if it went there, it's no big deal. It's done it twice before in terms of metrics. The issue is for us, not that, because I don't know where gold's going. To 20,000, I don't know. I've got some good friends who are thoughtful economist type, and they think they easily go into that zone. The issue is the ratio of silver to gold and the ratio of the gold miners to gold. And we think that is breaking out to the upside, favoring them because the last several years they've underperformed gold. Actually, since the 2015 low, you mentioned the gold miners a while ago. You measure from the 2015 low to the present, gold miners are actually beating gold, even though they're not above their 2020 price high, and gold is above its 2020 price high by a significant amount. But from the bare low, for instance, in the XAU index in December 2015, low monthly close to its current price, you go back and look at it on your charts, do the math. How much up is XAU? It's actually up more than gold is, measured from its low monthly close at 1,060 back in December 2015 to the present. Yes, they've lagged over the last several years where gold has launched and they've stayed below the 2020 high in the miners, that is. They're about to blow through that. And I think the ratio, the spread relation between the miners and gold is about to go vertical, where they outperform gold in this phase and silver does the same. And so I personally, and we state this in our reports, what positions we have. My emphasis is in silver and the gold and silver miners and in silver miners. Yes, gold is the mama. It will lead the way, but it won't lead percent-wise at this point going forward. We think it will lag the other components. Yeah, I think it'll be compressed into a shorter time period. In other words, it's already been, almost 10 years for gold upside. Well, from 2000, 2011 was 11 years. And I'm not counting you. I don't believe in the annual cycles because one of them from 76 to 80 was 3.5. Okay, it went eightfold. I'm just saying that it's likely we're entering the phase that's reflective, and go back and look at price charts from, let's say, mid-70s to 1980 on gold and silver. And you'll see that most of the acceleration of the upside was compressed in about 2 quarters in 1979. So in the last 6 months of that move, it went off the page. Similarly, in between 2000 and 2010, you had an advance, and in late 2010, silver went vertical into April 2011, and gold went vertical, more so than any prior point during that age bull trend. I think we're at that point now where the bull trend will now accelerate, and you will not see this arm wrestling staircase full of doubt type advance. You'll have a vertical type action. There's one factor we were waiting on to help provoke more aggressive movement in all markets, and that is the breakage of the U.S. stock market bubble. There's also a couple others around the globe. Japan is a bubble by our definition, and so is India, Sensex index. So it's not just the U.S. But the bubble has broken our initial trigger levels. Did it early, actually in January for the S&P, but the NASDAQ 100 held off. It just wouldn't break our key level. It broke it a couple weeks ago, well above where we are now. And that breaking that level told us that the bubble is going to start to unwind, meaning we're going to start a bear market. This is not a correction. Not that it has to crash. In fact, bear markets rarely commence with crashes. You go back through history, I think 29 is about the only one that started with a crash. And sometimes it didn't even have a crash. 2000 to 2002 in the S&P went down 50% and never had what qualified as a crash. Just bloody downside, layer by layer. So anyway, we think it's begun. Now, why is it important? It's important because it causes movement of money. Investor money, that especially late investor money, which is a lot of it, a lot of foreign capital as well, to flee that market and go elsewhere. And if you go back through history, and we've done studies on it and produced reports showing the evidence, gold is always the place to be, period. Now, 29 to 32, when we had the collapse then, you couldn't buy gold in the U.S. Roosevelt, it was illegal, like a drug, okay, whatever. But you could buy Homestake Mining, the biggest gold miner then, and it went up like 1,000% during that time. Okay, and then since like the 70s, when you had the bull market peak in the stock market, which I finally ended in a crash in late 74, gold went up during that time. In fact, during that crash period in the stock market, gold exploded. That's when it went up to $200. 2000 to 2002, during the dot-com bubble break, which was hardly a bubble compared to what we have now. I would call it, 1/10 the size of this bubble. Gold went up. In fact, gold went up from 2000 to 2011. It didn't just go up during those couple years. And, again, 2007 to 2011, 2009, the stock market went down and gold went up during that time. Yeah, there was an interruption in gold's upside that occurred simultaneous with a crash event that occurred in the stock market, which was a full year off of its high before the stock market ever had a break that you could call a panic crash. And gold participated in that for like 1 month and immediately turned around and resumed its bull trend.